Hello, everybody. Jim Young, Realcomm Live. So glad to be with you for this week's episode. We have got an exciting program today. We've got two great speakers. And just to give you a little idea of what we do, usually at the beginning of the year and every quarter, we kind of sit down and we evaluate what some of the top topics and trends are. And inevitably, one that came up to the top time and time again was the investment environment, Proptech. Who's investing in companies? Where's the money coming from? And so we decided to create a two-part series, today being the first of those, where we take an in-depth look at the current status of the investment landscape inside the real estate industry as it relates to technology. So we got two great venture capitalists on our show today. And with that, I'm going to bring in our first guest, Aaron Block, who is co-founder and managing partner of MetaProp. Certainly there he is. How are you, my friend?
How are you, Jim? Great to see you.
Great to see you as well. Well, I tell you, it's been a while, and unfortunately we can't be in the same room, but this is the next best thing, and I really want to thank you for taking the time to give us a little insight on what the heck is going on in the investment world.
It's always fun talking to you, and I'm excited for our chat.
So, one of the things that we've talked about in the past, and we kind of got caught up with yesterday, is the landscape as it relates to when it started in '08. But for right now, I want to just focus on 2020, and then what your prognostications are for 2021. So obviously, 2020 a tough year, for everybody, and I want to know from your perspective how that affected your world. And then where you think we are at this moment, and what do you think is going to bring 2021 is going to bring us?
Well, I think, obviously we've come a long way, baby, over the last several years in this industry. From a venture capital perspective, I'm not sure things have been as affected as they have been in other industries, including traditional property industry, which had, some real scares over the last several years, and particularly in 2020. In general, I can say from our own experience that it was nearly a banner year, which I think is surprising to some. And if you step back and look at some of the research, I was reading through AGC Partners research that they put out recently, 2020 seems to be a spectacular year by, depending on how you measure, but either by deal volume of what's happening in the PropTech space and by dollar volume. Both are, kind of way up. They're talking about $32.6 billion being invested into the space, thanks to some large private equity deals, of course. But also, if you look at 102 deals being done, according to them, in the M&A world and the public markets, I think that's, indicative of an increasingly healthy market. And if I was going to help the audience get one major takeaway from this, is in spite of and despite everything that's been going on politically and health-wise and real estate cycle-wise and economic cycle-wise, the market for real estate technologies is as robust as ever from the capital markets perspective, and seems to be headed in a very healthy direction.
Well, and let's for the average viewer who doesn't live in your shoes, daily, and it is somewhat confusing because we've got 40 million people struggling. We got multiple sectors decimated. Half the world's working. It seems the restaurant industry, the travel industry. I can go on and on, and you would see all the need for stimulus, and so those are negative things. And then in the real estate industry, a lot of empty buildings, right? So who's going to invest in technology if the buildings are empty? It seems contrarian. What are you guys seeing that the rest of the world's not, and why is this happening?
Well, we've been seeing the same thing that Travis, who's joining in a bit, and kind of everyone else who's been playing in the space for quite a while has been saying, is that the industry is ripe for innovation and for an evolution going through its technology transformation in a way that other industries have already been through. And I think that rising tide lifts all boats, even in an economically distressed environment. So what we're seeing is really, from my perspective, our crystal ball getting even clearer, that the early bets and the investments that were made and the commitments to the space when things weren't as clear several years ago, call it 10, 5 years ago, were really prescient, and that there's a bigger opportunity than most people identified in those early years and are starting to pile in now. Listen, I mean, Jim, it's a low interest rate environment. There's a lot of capital out there. Obviously, you mentioned real estate hasn't yet kind of been distressed from a capital markets perspective. If you take out, retail obviously has been struggling for a while. Hospitality is having a tough time today, but in general, you haven't seen huge distress and a wave of buying, and people are really looking to deploy capital to get yields and returns, and it's hard to find those last frontiers of opportunity, and Proptech really is. It's clear now, based on the exit activity, the M&A and the IPOs and the SPAC mergers, that this is a place that will be legitimate for not just entrepreneurs who want to solve problems with technology, not just enthusiasts who want to play around with cool new technology in the built environment, but also for the investors who want to back some of these great operating businesses that are tech founded and that can transform the entire industry. And that's kind of everything coming together in the whole ecosystem and pointing in a direction that is still very much, up and to the right. Sorry.
Yeah. So I wanted to add a little more context again for the people who don't live in your investment world. We've seen. Let's go back to like say 1999, the pre-dot-com era, right? So that, and right in between 99 and today was the financial crisis of '08. Which created this quantitative easing, all this these dollars coming to the marketplace, and just putting gobs of cash into people's hands. When I remember the first time we went through this, the terms of the deal were 24, 36 months, and at the end of those 36, and then if you pushed a little bit, you got to 4 to 48 months. But what the capital said back then was, we want a 10x, and we're betting on 10 companies. One might pop. But if we don't get 10x at the end of these 3 years, we at least want you to be cash flow. So we're not going to make our big returns, but I don't want to keep feeding you. So the world was 24, 36, maybe 48 months. Now it seems that the runway is much longer. Can you give the audience an understanding on why that is the case?
Yeah, well, I mean, I think most folks know that we're kind of the early stage specialists in Proptech, and we've got 129 positions built over the last 10 years in the space, and we understand those early formation years and the amount of time it takes to be able to monetize your position as an investor or as an entrepreneur. You need a return on your time and your capital investment. In those early years, I mean, correct me if I'm wrong, I was just graduating undergrad and coming into the work world and living in New York in the real estate industry, and it was my sense at the time that real estate minded investors were quick to invest during that kind of bubble period, during that last time tech was sold to be the new cutting edge innovation in the property business. A lot of folks were coming in quickly, early, and with a real estate mentality. I think there's a big difference this time around. Those folks have been late to the game this time around. There have been angel investors who have been really focused on early stage. There have been institutionalized seed investors. Travis, great example. We're great example. There are other really strong investors, and the real estate industry has slowly crept in, increasingly now, but slowly crept in. And has taken its cue in many ways from the institutionalized investing that has been happening. That institutionalized investing at the early stages in particular, are funds with 10-year return profiles, meaning that you're expecting to build positions if you're a professional investor over the first couple of years of your fund life, first 2, 3, 4 years. And you're expecting, to put a lot of effort in those first 5 or 6 years and only start to harvest in the out years. And that expectation from being an early investor and seeing your early bets pay off at huge numbers. Folks are looking for investments that can return their entire fund. Those could be 100x or more returns. Has really started to educate, I think, those traditionally real estate investors who would have come in driving real estate-like terms to kind of fall into line with reality of what it takes to get a new organization in the tech world off from idea all the way through to exit. Does that make sense?
Yeah. Do you see any reversal of that mindset, or maybe just a little bit more compression? Because there's one company I remember having a conversation with. They were on to their 5th round, and it was probably about a 7-year run, and they were nowhere near anything spectacular or profitability or even break even. And I just question after the fifth round if investors might be getting a little suspicious.
There's a lot of suckers out there, Jim. There's a lot of people who have too much money and too much interest, particularly in a space like this, right? Real estate folks tend to be entrepreneurial and investment minded, and want to chase the next great thing. And this is clearly the next great opportunity, particularly in our industry, of course, but I think more broadly across multiple sectors. Real estate tech is really hot. Proptech's a big deal right now. So, there are a lot of folks you can hoodwink into getting some capital. And just because you've had 2, 3, 4 rounds of capital doesn't mean that you have a great commercializable business that can scale and return, tremendously to your investors, particularly at each stage in its maturity, and subsequent rounds from the beginning. So, it's really hard to be great. So I think you can pick out example here, example there of greatness in the space. And you can also pick out a whole, plethora of examples of folks who aren't great and are probably not going to be great. The economics of funds like ours is you expect 1/3 of your portfolio to go to zero. I mean, that's the little known fact of early stage idea through Series A primary investing, right? 1/3 of your portfolio is going to return around 1x, and 1/3 of your portfolio is going to drive the real returns. And only a couple of those positions in each fund, maybe a handful, depending on the number of positions in each vintage, are going to be the real return drivers for you. So, I think it's hard in a vacuum to pick out an example and say that they were pushing in one direction. We see a lot of each of those segments, the least of which we see is those real return drivers. That's the magic. Those are the deals you have to get in as a professional investor. And that's part of the reason why a lot of folks choose not to invest in early stage tech. It's really, really hard, and you have to de-risk and hedge somehow. And unless you have access and flow, it's particularly difficult. So I would encourage anybody who's thinking about this space to invest with Travis, or to invest with us, or to invest with another institutionally kind of minded and backed specialist investor, because this is not a game for someone who likes to pick winners, right? It's much more sophisticated.
It's a law of averages.
Yeah.
So we only have a couple minutes. Crystal ball time. What do you like in 2021? What's a technology that's getting your attention? What is the next Google, if you will? What are you looking for?
So we just backed a company called Go4 out of Canada that is doing last mile delivery and logistics for construction sites. So getting just-in-time delivery on a construction site has been a real problem. You have folks typically running off to Home Depot or to the supply store to get your materials. They tend to be bulky, oversized, and tough to deal with. So a tech-enabled solution for that is really exciting. I say that as an example, Jim, because I think a lot of those areas that mix e-commerce, which that does, logistics, which that does, and construction, which that does, those are 3 areas that we're individually very interested in. And the culmination of those 3 together in one place with a great team and a huge opportunity, they just became, I believe, Home Depot's partner all across Canada for these kind of just-in-time deliveries, is really exciting. We've looked quite a bit in the residential space over the last 9 months or so, which I think is quite timely. We've seen a boom in residential. You can get proof of your success or failure very quickly. And as early investors, you have to figure out quickly whether you're on the right track or going to meander for a while, so that you can balance your time and your follow-on capital. So we've had a lot of interest there. There's also interestingly enough, there's a lot of models being replicated from the United States into international markets that are increasingly interesting. Of course, iBuyers here with the IPO of Opendoor have been, have been very attractive and have been doing very well after a bit of a pause early on in the COVID crisis. It's really a hot space to be in. You're seeing a lot of copycats in Latin America, Europe, and Asia around that type of business. We funded a company called Dongnae in Korea that is essentially the Opendoor for Korea that we're very excited about. So those are some of the areas we're really excited about here. Of course, all the buzzwords are still very exciting. AI, computer vision, machine learning. These are things that we continue to invest in, but they're not really categories. They're more kind of must-haves within technologies that are solving bigger Proptech problems.
Well, unfortunately, we're out of time. I could talk for hours. We're going to have you back. Again, this weekly show is designed to, find the pulse of what's going on today, this week. And I really appreciate you taking the time to be with us. And and sharing all your insights. It's important to be able to get to guys like you and know what's going on the street. So I appreciate it.
Thanks for having me, Jim.
All right. You have a great day and you be well.
Thanks. You too. Bye.
Take care. All right. With that, let's take a couple seconds and hear from another great sponsor, BearTech, and then we're going to come back with our second guest. All right. Again, thank you to our sponsors. Really important part of what we do. So with that, I'd like to bring in our next guest, same topic, but a little bit different perspective. Travis Connor is co-founder and the general partner of Building Ventures. There you are. How are you, Travis?
I'm great, Jim. How are you?
I'm well, and you are coming to us from Boston, correct?
That's right. I don't know how I drew the short straw and had to follow, Aaron and his insights, but I'll do my best to be helpful.
Oh, don't sell yourself short. I've been on stages with you and had this conversation, and you're doing some really good work. And we, as you know, we debated whether or not we would have the two of you on together or separate you, and we decided to separate you because we didn't want the blending of the conversation to take away from each of your individual perspectives, right? Because the investing in any kind of new company, in this case, Proptech, it's got a lot of moving parts, a lot of different angles, and a lot of different perspectives, and that's why we wanted to have you come on. We'll talk about the same questions, but we're going to nuance it a little bit. So from your vantage point, your summary of 2020 and a little bit about looking at 2021. What do you see happening?
Yeah, I'd say that 2020, for all of its challenges that we all faced, as it relates to this sector, is really exciting because it challenged the fundamental assumption that we all have, which was that we needed office space for everybody in a company 5 days a week. We speak to many executives who have always thought that that was just how things worked, and they thought it was a requirement. And we've had to learn that businesses can function without everyone in the office every day. There's pluses and minuses to it. And now, as a result, you've got an entire marketplace asking the question, what is space for? What do I want it for? The end occupant is much more in the discussion as to what's going to be valuable enough to attract my employees to come back to the office. And for the tenants themselves, figuring out what are their needs going to be, right? And so I think that opens up, having cracked that open, we now have all kinds of interesting opportunities to reimagine what space is for, how we deliver it, and how we operate it.
Right. So, this digital transformation, this blending of virtual worlds and physical worlds, it's been going on 25 years. This is not new, right? I mean, once the laptop computer was invented and you could get internet access, the workers started to move around at a much greater pace. What I think is interesting this time is with COVID is it was a crash course. It happened in 12 to 24 months. Even CEOs who were, no way would they ever, think about digital transformation or allowing their workers to work at home at the same level. Do you think that the speed of the paradigm shift is going to end well, or do you think there's going to be some abrupt pain that we might experience as the shift is taking place?
I've seen all the same surveys that you have. My belief is that the vast majority of people are going to want some sort of hybrid working conditions. People, for the most part, like the office, want to be in the office, but they want greater flexibility about how they use it, what's it for, and when they use it. And I think that is going to be a tremendous challenge for tenants, which will then be pushed onto owners and operators around how they deliver it. So I think it's going to create some hard questions. I think there's going to be a push for much greater flexibility. That flexibility is going to ultimately impact the revenue streams, the predictability of those revenue streams for owners. And as a consequence, they're going to have to understand how they operate the building much more effectively and efficiently to meet those demands.
Right. And you're hearing some of these, we were talking earlier about, Turks and Caicos and all and the Hawaiian Islands that are now encouraging people to come and work for 3 months. We call them digital nomads, right? And recently I was talking to somebody that said they did a survey in a company of about 7,000 employees, and 85% or so said they never want to come back to the office, which was an extremely high number, right? And again, this is not going to be all or nothing. It's not going to be office or work from home. It's going to be somewhere in between. And are you getting any sense from the data you're looking at what percentage of people, though, are going to want to come back 3 to 4 days a week, which people, compared to the people who may want to come back once a month? Are we getting a sense of how big this shift is going to be?
Yeah, I mean, blending across a number of sources, I would say it feels like 75 to 80% of people want to be in the office some days a week. So I think one of the challenges is going to be that you're going to have office space for peak usage, knowing that there's going to be a lot of flexing in that. People are going to want the ability to work kind of anywhere. I fundamentally believe that people enjoy being in the office. They like the community. There's a lot of learning. There's obviously faster iteration. We have this discussion amongst our own portfolio companies, which tend to be younger in demographic. And even though there's very engineering heavy and people can do their work alone, they want to do it together, and it allows companies to move faster together. It's one of the advantages that startups have over incumbents. But what people really don't like is commuting. And so there's, lots of discussion as to, are people going to have a hub and spoke system, which I think will become more prevalent, and have branch offices that are closer to their employees as well as their downtown core office. I think there's a lot of CFOs who are hopeful that this means that they can allocate less of their dollars to space. I think that we're likely to see the opposite.
Because we did our hybrid event in November, where we put a stake in the sand and said we want to bring people back in. We knew it wasn't going to be Nashville, 2,500 people, but we just wanted somebody. We ended up about 60 people, not a lot, but it was 60 people who cheered and yelled and screamed when we opened up our general session, and they were just grateful to be in the room. I mean, it was probably, despite it being one of the worst years, from the events business, it was actually one of my best years from taking some real risks and trying to push the envelope, right? But we as a result of it, we experimented and saw a lot of emerging technologies as it relates to taking the Zoom call or the Teams call to the next level. And what I'm not seeing yet is the real estate industry understanding that and trying to bring that technology into the space to give their employees something they can't get at home. Are you starting to toy around or seeing any of these types of techs?
Yeah, I wouldn't say that we've seen any adoption, but they certainly exist. I mean, I think the real estate industry, being somewhat of a laggard as an adopter, has the benefit of skipping over some of the missteps and mistakes that other industries have had in the past and can move to the future. But what it really requires is a mindset that says, what's the customer experience I have to deliver, right? I think WeWork was an early wake-up call that a better office experience was something that people desired. Now, if people's choice is what they have at home, it better be better, either by the way that you can collaborate, operate, being able to be in we do a lot of stuff on the construction tech side. If you've ever been in a room, BIM cave dedicated to being able to walk through a model with large screen monitors, that's a transformational experience you can't get. You may be able to look at it on your phone, but it's not the same thing. It's like the experience of going to a movie theater to see an action movie. And so I think there's going to be much higher demand on delivering an experience that makes it worthwhile to come to the office.
Both an analog experience, the coffee shop and the restaurant, and the climbing wall, and the digital experience as well. What I worry about, or I think about a lot, is the idea that these owners, are dealing with. We just got a phone call this morning with somebody from London, and he put a big figure out there, in the B figure, the billion figure, as far as uncollected rent dollars in 2020. Okay, and nobody's really talking about that. I mean, there was a lot of rent not paid in 2020. So here it is, we've got these companies struggling, for collections, and now we're telling them, these real estate companies, oh, you got to make all these new investments in COVID tech and wellness and sustainability and experiential. They like to make money too. At what point does it become, too hard to try to make this transition?
Yeah, I agree. There's going to be pain, because I would say it's kind of a perfect storm, right? In addition to all these end user demands and the collecting rent from the suffering that you've had now, you also have new regulatory demands. on the space.
Exactly.
You got local law 97, the recognition that our built environment generates a huge amount of the greenhouse gases, and that we have to actively try and mitigate that, as well as capital markets are beginning to pay attention to that, right? Insurance and underwriters who want to see the sustainability profile of the assets that they are underwriting. We were joking.
A lot of pressure. The old days, you got space, you fixed it up, you rented it, and you talk to your tenant once a year.
Yeah. Boy, and oh, by the way, nobody wants to sign a 7 to 10 year lease because there's plenty of flex options available.
So the whole financial structure is being pulled out, because how can you create a financial model on the debt side when people don't want to pay rent, sign a lease for 5 to 7 years? They want it, daily. A lot of moving parts.
So in that turmoil is opportunity, right? We pay an awful lot of attention to what we think of as the leading edge of customers, the Facebooks, the Microsofts, the Salesforces of the world, see what they want. Those companies are willing to pay a premium, right? I mean, it was very counter programming to what was going on in the pandemic when Facebook took all that space in Manhattan.
Right. But here's the confusing part. They also said they're employees. You can work wherever you want. Right. So again, that balance. How much will the pendulum swing either way?
But by knowing that the onus is on them, is deliver a great employee experience in the office that can't be replicated at home, and people will come.
So I'm old enough to remember that the reason I went into the office initially was the $80,000 Xerox copier printer. My files were in manila folders in the desk. My desk was there, and so was the conference room. All that's been replaced now by virtual experiences. So we have to take the experience to the next level. What is the new Xerox copier, if you will, as the reason to go into that office? So
yeah, and I think it's ease of communication and collaboration, right? We've also learned that when you work from home, your to-do list is there the whole time. My colleagues and I used to joke that wouldn't it be great if we could have the dogs in the office every day, and then we spent some time at home with the dogs every day and said we don't need them staring at us. It's kind of great that they're not here.
Unfortunately, we are out of time. We're going to have you back because 10 minutes isn't enough. Great insight, but this is a little sneak preview for our audience as to the kind of insight and experience you have, and I really appreciate you taking the time. And you have a great day, and hopefully stay well.
Yeah, my pleasure. I'm a huge fan of Realcomm and all you do to educate and evangelize for the industry. So thank you.
Thank you. Be well.
All right. Take care.
All right. Well, what a great job I have to be able to talk with two great people like that. Willing to share, taking risks, pushing the industry forward, and it's an absolute pleasure. So before I wrap the show, what we're going to do is say thank you to one more of our sponsors, and then I'll be back to wrap. Oh, I'm sorry, I'm not.
Altus Group's software, data, and advisory services help bring the clarity, perspective, and insights you need. Altus Group's software, data, and advisory services help bring the clarity, perspective, and insights you need to minimize the risk and maximize the value.
All right, well, that was my fault. Josh got called for a commercial when it wasn't ready to come yet. I'm supposed to be bringing my good friend Howard Berger on. So with that, Howard, how are you?
Shout out to Aaron Block and Zach Aarons on their recent book, Proptech 101, which I think we actually helped introduce at our conference in Nashville. It's the ultimate guide to all things PropTech and is available in hardcover Kindle audiobook on Amazon. So just shout out to you guys on the book. So here's a sampling of our featured stories from our weekly news briefing that's released every Thursday, 11 a.m. Pacific. Subscription's free. Sign up, go to our website, realcomm2ms.com, and click on news. So this week's lead article comes from James Dice, Nexus Labs. He does a weekly blog, podcast, online, school, and smart building consultancy. And born of frustration over the archaic state of our smart building adoption in the US, James articulates to this fictitious character, Mary. She's a fictitious mechanical engineer who has become jaded, threatening to leave the industry. And James articulates some of the major impediments in smart building adoption and why our building engineers really need to double down on educating the industry. And in this conversation, he boils it down to 5 project fail points. Need to involve more stakeholders throughout the smart building project, problem of focusing on the tech rather than the end result, lack of a systematic approach, bad vendor decisions, And finally, overall, we make lousy business cases that we can't make sense to our executive leadership. Overall, that was just a quick run through that. It's a great read, don't miss it. Also this week, unless you've been totally off the grid living under a rock, you probably heard about the SolarWinds breach, where in late 2020, Russia targeted US government agencies in a very broad cyber espionage campaign by compromising SolarWinds, a widely used IT infrastructure platform, which affected about 18,000 users, making it one of the most complex, damaging cyber breaches since Stuxnet. So the SolarWinds saga just keeps on going. Researchers at Symantec uncovered yet a fourth associated malware strain called Raindrop, designed to deliver a payload capable of a bucket load of mischief, such as key logging, command execution, file transfer, and port scanning. We've seen a few other malicious variants from SolarWinds, like Sunspot, Sunburst, Teardrop, now dealing with Raindrop. Stay tuned. I'm afraid this story is going to unfold for quite a while. And then finally, we were talking about this with Travis. Computer vision video analytics are two of the fastest emerging technologies, and the applications are only limited by our imaginations. Think about coupling security cameras with artificial intelligence that can literally recognize and understand what's in their field of view and then trigger commands. Possibilities are endless, but of course, ethical questions, which we'll skip over for now. Recently, Peachtree Corners in Georgia deployed AI-powered video analytics technology in their city hall to automatically detect when someone isn't wearing a mask or if groups of people aren't observing social distancing. And for this application, they're not using facial recognition or personal identifiable information, which does lessen the big brother stigma a bit. And the alerts are very accurate and virtually zero false positives. So buckle up, especially if you're a little bit on the paranoid side, because I think we're going to be seeing a lot more of this. I'm out of time, so that's it for me today, but there's much more in our weekly briefing. Check it out, and I'll see you all next week.
Yeah, Howard, we are going to, the privacy issue, I predict in the next 3 to 6 months, it's going to become one of the most important issues in our industry. Thank you for bringing that to our attention. And as you said, buckle up. It's going to be an interesting 90 to 120 days. So,
Thanks, Jim.
Thank you. All right. Before I wrap, we're going to say thank you to our sponsor one more time, Altus, and then I'm going to come back and give you a little bit of update on what next week's show is going to look like.
Altus Group's software, data, and advisory services help bring the clarity, perspective, and insights you need to minimize the risk and maximize the value of your investments. Because it's not simply how much data you have, it's how clearly you see it.
All right, so first of all, I just want to make a point that is why I love this particular Realcomm Live, because it is live. And do we make mistakes? Yes, it's actually part of it. And typically people don't like to take chances, they don't like to fail. But I will tell you, in the upcoming years, where we are right now, you have to be at the plate swinging. You can't stand in the front or sit in the front seat. Even if you strike out the first couple times, now is the time that you, as uncomfortable as it may be, you have to take chances. And guess what? Sooner or later, that strikeout's going to turn into a base hit, and sooner or later, you're going to be hitting home runs. So with that, I want to say thank you to all of our guests and our sponsors this week. Thank you to Howard and team for the news briefing. And next week, we're going to do part 2 of this conversation. Same thing, in real estate, technology, Proptech, investing. Where are we? Where we've been, where we're going. And we got 2 great guests, Scott Moore from 111 Advisors and John Fitzpatrick from Blackstone. So, you know, we got an owner, operator, as well as a consultant, seeing all different things. And I think it's going to be a nice complement to what the discussion we had today. So with that, I'll say goodbye for now, and we'll see you next week. Be well and thrive.